Hello everyone, welcome back to the channel. Today, we are going to discuss one of the most important topics in accounting, final accounts adjustments. Adjustments are necessary to find the true profit or loss of a business and to show the true financial position in the balance sheet. In this video, we will clearly understand each adjustment, its journal entry, and its treatment in final accounts, that is, trading account, profit and loss account, and balance sheet. Let's begin. Final accounts adjustments are accounting adjustments made at the end of an accounting period to ensure that the final accounts show a true and fair view of the business's profit or loss and financial position. These adjustments arise because some incomes or expenses may relate partly to the current year and partly to another year, or because certain items are not recorded in the books during the year. The main objective of final accounts adjustments is to follow the accrual concept and matching principle, under which incomes and expenses are recorded in the period to which they relate, irrespective of whether cash is received or paid. Purpose of final accounts adjustments: to correctly calculate gross profit and net profit, to properly value assets and liabilities, to allocate incomes and expenses to the correct accounting period, to present accurate trading account, profit and loss account, and balance sheet. Closing stock. Generally, closing stock is not given in trial balance. It will be given under adjustment. The adjusting entry is closing stock account debit to trading account. Generally, closing stock is not given in trial balance because it is valued at the end of the year after the accounts have been closed. In other words, closing stock is not a ledger balance. Treatment in final accounts. I. Closing stock is shown on the credit side of trading account. 2. It also appears on the asset side of the balance sheet. Sometimes the value of closing stock appears in the trial balance. This means closing stock has already been adjusted in the purchases, deducted from purchases, in arriving at cost of goods sold. In such a case, closing stock should be shown only in the balance sheet, asset side. Outstanding expenses. Outstanding expenses are those expenses which remain unpaid at the end of the accounting period. In order to arrive at true profit or loss, it is necessary to take into account the outstanding or accrued expenses. Adjusting entry. Expense account debit to outstanding expenses account. Treatment in final accounts. I. Outstanding expenses should be added to the concerned expense on the debit side of the trading account or profit and loss account. 2. It should also be shown in the balance sheet as a liability, current liability. If outstanding expenses are given in the trial balance, credit balance, then it should be shown only in the balance sheet as a liability. Prepaid expenses. Prepaid expenses are payments made in the current year but relate to the next accounting year. In short, prepaid expense is an expense paid in advance. For example, insurance premium of Rs 6,000 is paid up to 30th June 2009. The accounting year ends on 31st March 2009. This means insurance premium of Rs 1,500 for 3 months from April to June has been paid in advance, Rs 6,000 multiplied by 25%. Prepaid expenses are also known as unexpired expenses. Adjusting entry. Prepaid expenses account debit to expense account. Treatment in final accounts. I. Prepaid expenses should be deducted from the concerned expense on the debit side of trading account or profit and loss account. 2. Prepaid expenses should also be shown on the asset side of the balance sheet. If prepaid expenses are given in the trial balance, debit balance, then it's accrued income. Accrued income is the income earned but not received by the end of the accounting year. Such incomes arise in the case of interest on investments, rent on buildings, commission, etc. This is also known as outstanding income. Adjusting entry. Accrued income account debit to income account. Treatment in final accounts. I. Accrued income should be added to the concerned income on the credit side of the profit and loss account. 2. It is also shown on the asset side of the balance sheet. If accrued income is given in the trial balance, debit balance, then it should be shown only on the asset side of the balance sheet. Income received in advance. Sometimes the whole amount of income received in an accounting year does not belong to the current year. A part of it may relate to the next year. Such portion of income received but not earned is called income received in advance or unearned income. Adjusting entry. Income account debit 2. Income received in advance account. Treatment in final accounts. I. Income received in advance should be deducted from the concerned income on the credit side of the profit and loss account. 2. It should also be shown on the liability side of the balance sheet. If this item is given in the trial balance, credit balance, then it should be shown only in the balance sheet on the liability side. Next video content, Final Accounts Adjustments, Part 2. Topics covered in this video. Depreciation of fixed assets. Provision for depreciation. Bad debts. Provision for bad debts. Provision for discount on debtors.
Thank you.